Hey there, everybody. This is Bob Trade Genius. Got my good friend Phil here. We've got ambushed by Moody's. What does it mean to you and to our portfolio? Stay tuned.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening. Okay, Phil. First of all, we got to apologize. We had a glitch in the matrix again. So what we're going to do is we're going to actually do a video Saturday and Sunday to make up our missed video. But I want to throw this to you, Phil, because this has happened before. And we knew something was weird all day yesterday. The market should not have reacted so incredibly positively the day after a bond blow up. At the end of the day, we found out why. I'm going to throw it to you.
Yeah, it was a kind of an odd day. It started off where we thought we would go down and kind of touch on the lows overnight, didn't do that. And then all of a sudden, it was like someone flipped the switch and we got a really contrived move with very little pullback all through the day, all the way into the end. You didn't even get an end of day pullback that clears out some of the stops. So, it was very odd, and we were commenting that it's kind of interesting price action. Well, then sure enough, right before futures. So when the stock market closes and then even the options market and SPY, you have about 15 minutes. After that, you're stuck for the weekend. The only guys that can get out are the guys that trade futures. And at 4:39 p.m., Moody's comes out, changes the outlook on United States ratings to negative, mentions that the downside risks to the U.S. fiscal strength have increased, fiscal deficits will remain very large, debt affordability in the U.S. to be significantly weakened, and absent any policy action, fiscal strength will decline. So they were just shooting shots across the bow. There was several big orders in the futures that were executed, and futures dumped about 10 to 15 points on that, and then the markets all closed for the weekend. So the large portion of this market has not been able to price in the reaction to this. So what does that mean for us going forward? Well, we can kind of look back in history and see. Now, I will say that there's some things that you got to understand about these. This is a negative outlook, not necessarily a downgrade. So there's still a split rating here. Another thing too to keep in mind is that a lot of things were reworded in terms of collateral when things had to be AAA rated. It used to say AAA rated. Well, that creates a problem in case you do get a downgrade out of the blue. That creates a lot of collateral effects in the markets, let's say. Now they've changed it to be AAA rated or government debt backed by the US. So even if you do get a downgrade, it's not as impactful as it once was, and they changed that after 2011. But still, these tend to have a negative reaction. So if we look back, the last time Moody's had mentioned a negative outlook on the US was back in June of 2011. So let's take a look at that chart. And what you're going to see there, that red vertical line is our date that they downgraded. And it came off a similar move where we had a squeeze, right? We were in a market down leg and we were getting these squeezes up, and then that came in. So structurally, we're a little similar in that regard. But you'll notice we had several days of down. We spent the better part of 2 weeks hammering out a bottom, and then it came back up and then eventually rolled back over. I know this is a different time of the year and a different macro picture, but I could actually see something like this similarly playing out because you have the negative reaction, then you have that December push, right? And then we get the realities of a slowing economy and we roll over into what we would consider the recession trade. So I think you need to be prepared for some negative market reaction come Monday and going into next week. How much of that really remains to be seen. I still think 4,300 is a really important level. If we start cracking under 4,300 on SPX, then I think the move can get some legs and it might go lower than people are comfortable with. Might even take out that recent low. But at that point, I think you have to stop and look at, there's still a lot of stock buybacks that have to come into the market, Bob. You have to recognize there are some tailwinds that come into this market. But if we lose 4,200 after 4,300, you may have enough volatility and the VIX might go up enough to counteract some of those buyback flows and actually go into that negative spiral again. And then at that point, if we fast forward to where we are today in the chart, you'll notice we have this megaphone pattern, which I'll let you speak to. But the big level is that weekly 200 SMA here down at the bottom. And we got pretty close to it, and the market came in and was bought right back up. But typically your bear markets start under that. that weekly 200 SMA. So if we do start to crack this low and we do not bounce, let's say we get down to that weekly 200, if we start losing that, watch out below.
Yeah, and this megaphone pattern is very interesting because we're at an inflection point here, Phil. As you zoomed in on that, where I think it's an easy decision for us now. So if the market weakens, which would make sense with these megaphone patterns, and if it breaks above this, then then it looks like we're going to go up to that next channel line higher there, and we're going to get a massive rally. But I personally, going Thursday, I thought we'd be weak into Wednesday, and then start getting the flows for Thanksgiving. But this move we had on Friday was another front run. I think they're panicking a little bit, Phil, and they're desperately trying to they got the gap to fill. They're trying to get as much liquidity as they can to reposition themselves. So I wouldn't be surprised with either scenario at this point. Typically, if Friday's up and it's OPEX week coming, Friday up, Monday, Tuesday's up. And that's how you have to play it.
Right.
But this news on Friday evening could throw a kink in this thing. And I don't know if it wasn't kind of a planned ambush, Powell and Yellen are at some sort of, quiet war here between each other. She doesn't want to take any pain whatsoever because she's a politico, and he's trying to, look towards longer term survivability of the banking system. And, with that and the Fed, remember, progressive liberals don't want a Federal Reserve. They want it to be slaves to the political machine.
Right.
And and the Feds and the banks want to maintain their independence. They're both evil in my eyes, but I'm just saying that's the war we're participating in right now. And I don't know if he knocked on Moody's door and said, hey, we got to get that 30-year yield up. We got to put the administration on notification. This bond auction was a bust. Nobody's going to buy the 30-year bond unless it's going to get 3 or 4 points over the short-term money. And until that happens, I think we're going to have bond failure after bond failure. And I know you talked about it before, Phil. You can't keep doing T-bills like this because if you get an extraordinary event, she may find herself in a situation where she just simply can't fund the government. The prices would be so high. And people will say, oh, it's just, money, but it rolls through the entire economy. And at the end of the day, do you really want the government to be the only one that's tapping into the bond market or borrowing money? Because then we're going to have a really, really messed up economy.
Yeah, there needs to be a large buyer of bonds, and it's just not here. And I don't think the institutions want to touch it until, like you said, over 7%, maybe higher, which means we still got some more to go down. But beyond that, and I'm talking beyond where that's your recession safety trade, right? Locking in 6, 7, 8%, let's say on the long end, right out the recession as the equities are giving negative return. But beyond that, they're not reining in the spending. They never will probably at this point. So you need to create a major force of buying. And that's something we're going to get into in the next video because I think Bob uncovered a very interesting plan that might be in play. You guys aren't going to want to miss that. But if not, what's going to end up happening is the yield curve control is going to kick in. And then you're going to blow out inflation. All this work that they did for inflation is going to go out the window. So I think it's an option that the Fed desperately is trying to avoid. And that's why I think you're going to want to watch this next video, guys. So let us know your thoughts on all of this. Big surprise there at the end of the market close. Probably going to be a volatile week ahead of us as the market digests this information, and who knows who got stuck. And if it gaps down on Sunday night in the futures markets, it might be very volatile come Monday or Tuesday. So we'll just have to see how that is digested. But let us know what you guys think and if that's going to change your outlook on the market and where do you think the market's going from here. We'd love to hear from you. Otherwise, check out our specials over at TradeGenius.co. We got Black Friday specials, big discounts or biggest discounts of the year. You can get software packages, training packages, courses, indicators. So check it out. And we'd love to see you in the room and help you navigate these wild markets right now. So thank you, Bob. We'll see you guys in the next video. Take care.
Trade Genius.